Welcome back. Today we're looking at a really high conviction investment report, the AI Monopoly, why ASML is the one stock you must own for 2026.
The thesis is that ASML is basically the toll gate for all future AI infrastructure, all thanks to its monopoly on high-end lithography.
And it's an incredibly strong foundation. I mean, the material is clear, the catalysts are perfectly timed, you've got the memory supercycle, the 2-nanometer foundry wars, it all just clicks.
It really does. That toll gate concept is immediately engaging.
Yeah.
We absolutely agree on the strengths, the logic is sound, but, our job here is to help turn a strong report into an absolutely ironclad one.
Right, moving beyond conviction into, certainty.
Exactly. We've found 3 key areas where a little more focus on the structure and the quantitative support can just maximize that confidence.
Okay, let's get into it. So the entire foundation of this piece, it really rests on the technological moat. The report's core thesis, that 100% monopoly on EUV lithography, would be so much stronger if it proactively contextualized why it's necessary against, advancements in adjacent manufacturing processes.
This is so crucial for any long-term investor. Right now, the report correctly notes that ASML's competitors, Applied Materials, Lam Research, they focus on deposition and etch.
Right, the stuff that happens after the light does its work.
Exactly. While ASML has zero competition in the light source itself. But there's a subtle assumption there.
And that's the friction point. The contrast relies on this idea that no breakthrough in, say, deposition could ever fundamentally change or lessen the need for that 2-nanometer precision.
And when you're looking at a multi-year horizon, way past 2026, just relying on the current lack of competition, well, it kind of overlooks a disruptive risk that could come from somewhere else entirely.
It's a gap in the argument. The person reading needs to be absolutely certain this toll gate isn't vulnerable to some kind of process hack.
Yeah, what if someone finds a way to use, superior deposition or some complex multi-patterning to get that density without needing high-NA EUV's resolution?
Then the monopoly and the whole thesis is weakened, fundamentally. So to really solidify that long-term endurance, the suggestion is to reinforce the longevity of the toll gate by briefly explaining why these other processes just can't get around the fundamental need for ASML's tooling.
We need to prove this moat has to endure, regardless of what happens elsewhere.
Exactly.
But, I worry. Does adding a paragraph on physics sort of distract from the investment thesis? How do we keep it concise and not make it feel like a footnote?
Well, we don't need to deep dive into optics, but we do need to anchor it in the target product. So instead of just saying the moat exists, dedicate a line or two to confirming that even with the absolute best deposition and etch techniques,
Which are important, for sure.
vital for clean manufacturing, yes.
But achieving the transistor density you need for a chip like NVIDIA's Blackwell or the future Rubin series, that is fundamentally constrained by the lithography resolution limit. It's just optical physics.
Precisely.
Explain that this dependency ensures that the high-NA machines for 2-nanometer and below will remain essential infrastructure for the foreseeable future.
You're making the conclusion much less vulnerable to a skeptic who might imagine some material science breakthrough changing the game.
It just closes the loop on the whole technological argument.
And if we can prove the moat is sound through physics, the next challenge is proving those price targets are sound through, arithmetic.
Absolutely. So moving on to our second point, let's talk about the financial targets. The qualitative drivers are phenomenal. We all agree on that.
The 2NM wars, the supercycle, yes.
But the sheer scale of the price targets demands equally robust quantitative support. I mean, these are aggressive numbers.
1,000, even up to JP Morgan's target of 1,275 euros. It demands a quantitative highway to get there. To elevate the analysis, the argument needs a more explicit quantitative bridge connecting the specific 2026 catalysts, the high-NAND rollout and the memory supercycle, to those big analyst price targets.
Right, because right now the report presents the 3 pillars, memory, 2 nanowars, pricing power, and then it just lists the price targets. It relies too heavily on implication.
We see the operational wins, Q3 2025 bookings of 5.4 billion euros. But we need the exact math that shows how that success forces that higher valuation ceiling.
And the report notes that the market will focus on 2027 growth, which is correct. But if the whole point is this is a must-own for 2026, then we're missing a clear estimate of the immediate 2026 financial impact.
You need to see the model. That $1,275 target can't just be cited from an analyst. It needs to be constructed for the reader piece by piece.
I totally agree. So the suggestion then is to quantify the revenue boost from high-end adoption and the resulting, tectonic shift in the machine's average selling price, the ASP.
That immediately justifies the valuation jump. We have to show the reader how they get from point A, the catalysts, to point B, that target price.
Yeah, the people reading this kind of analysis are sophisticated. They want to see the mechanism of value creation.
This is where you show control over the financials. So for concrete examples, maybe provide a simple framework for estimating that revenue contribution. You could start with the most dramatic part. Calculate the percentage increase in ASP between a standard EUV machine and the new high-end one, which is what, about $380 million?
Around there, yeah. And that difference is just pure pricing power. It's the monopoly in action.
And that connects directly back to the capacity expansion you mentioned earlier. The memory supercycle isn't just about using old machines more.
No, it's about expansion and upgrades, which drives new unit sales. Exactly. You need to illustrate how that accelerated expansion from SK Hynix and Samsung translates into actual projected order numbers for 2026 high-10 deliveries.
You link those orders directly to the revenue growth you need to support the high end of that analyst consensus.
Yeah. If an analyst assumes, say, 10 Heine deliveries in 2026, show the operational pipeline that proves that volume is achievable.
Showing that linkage is the difference between qualitative conviction and quantitative justification. It's hugely actionable, which brings us, I think, very neatly to our third and final point.
The risk analysis.
The crucial risk analysis. The report is dead on. It identifies China export bans as the key risk.
Given the timing, late 2025, and all the geopolitical friction, that is absolutely the right focal point for a bear case.
So, the report's identification of China export bans as the key risk is appropriate, but the bear case that follows needs to be refined by structurally quantifying the potential impact of those restrictions.
The weakness here is that the bear case summary is a little, well, it's generic. It just says, China sales collapse entirely, and that leads to a stock retesting the $800 lows.
It's just a historical price floor.
Right. Since this is the only key risk specified, the analysis should be stress testing the monopoly by modeling the actual financial consequences of that specific threat.
And it's a bit thin on risk mitigation, too. The report says, rest of world growth should offset the drop, but it doesn't detail how. How does that offset actually balance the loss of China?
We need to ground the mitigation in clear numbers. You have to prove that the bull case drivers are strong enough to cushion that specific fall.
That makes sense. So the suggestion for improvement is to ground the bear case in quantifiable risk metrics, model the required offsetting growth, and maybe anchor the analysis on a key financial health indicator, like gross margins under stress.
I like that. It shifts the bear case from being just a downside price target to a structured risk analysis with clear mitigation paths.
Which is so much more valuable. It demonstrates control over the narrative even in the worst-case scenario.
Absolutely. So to make that downside more robust, you'd calculate the exposure first. What specific percentage of that reported 5.4 billion euros in Q3 bookings came from China?
Use that figure. Project the maximum potential revenue gap for 2026 if the ban is fully enforced.
And once you've defined the size of that hole,
you complete the loop on the mitigation strategy.
Exactly. Then you demonstrate the minimum required acceleration in orders from TSMC, Samsung, and Intel, the guys driving the 2-nanometer foundry wars, that you need to maintain your growth trajectory despite that headwind.
You could even calculate it. How many extra high-NA machines would TSMC need to order in 2026 to completely neutralize the loss of the Chinese business?
And that level of analysis proves that the non-China bull case drivers are not just strong on their own, but structurally strong enough to absorb the main external risk.
It moves the conversation from just, acknowledging risk to providing a real pathway to financial stability.
It just makes the entire report feel as robust and logically supported as it can be, which is really the hallmark of high-quality research. This has been an incredibly insightful critique. So to recap for the person who submitted this work, the material is excellent. The focus on ASML as the toll gate for AI is spot on. You have a really high-quality foundation here. And we focused on 3 core areas just to strengthen this for maximum impact. First, contextualizing that long-term tech moat against adjacent technologies, explain why lithography resolution is still the fundamental bottleneck.
Second, creating that powerful quantitative bridge between the operational catalysts, the high-NA rollout, the memory supercycle, and the aggressive price targets. You do that by modeling the ASP increase and the required order ramp-up.
And finally, deepening the structural analysis of the China export bans within the bear case. Quantify the exposure and then explicitly calculate the required offsetting growth from TSMC, Samsung, and Intel to maintain that revenue trajectory.